Hey everyone, my name's Andy. I'm from Finding Value Finance. Today we are blessed to have with us TraderFerg. And I know some of you guys wanted me to get him back on the channel that are part of the community. So we've got him back on. That's good. And thank you for coming back on. Appreciate it.
Thank you for having me.
Right now, the first question I just kind of want to run by is, what's your views of the market right now? How's it looking? What are some sectors that you think look interesting? What are some that maybe don't look as interesting? Kind of what's your views on the market right now?
Um, I just think we're in an interesting period where some of the some of the sort of the fantasies are starting to sort of break down, like the idea that we're just going to hit this 100% sort of renewable world. We're just watching as day after day, just more and more sort of, whether it's cost inflation, whether it's just a lot of the alternative energy space has been proven to be uneconomic. I've got this chart that I sent out in my latest newsletter that just shows this absolute boom in alternative energy. Just essentially went vertical in 2020, and it's just come crashing down. And at the same time, the sort of fossil fuels or the conventional energy space is almost a mirror image of it. It got crushed off the back of COVID, and everyone sort of pretended we'd seen whatever it was, peak oil consumption, and now it's just roaring back. And it's interesting to see like lots of pivots. Like even I was just looking at one. There was a study that was looking at all the BlackRock proxy votes and how they were voting for ESG, and it was 2020. I think it was like high 30s, even 40% was pro sort of ESG, pushing that hard in it, and it's gone down consecutively every year to now it's sort of in the low teens. So it's interesting they're kind of pivoting away from it as well, as they're seeing a lot of these projects just be horribly uneconomic, and even the subsidies can't kind of prop them up. You're seeing, yeah, I was just reading an article this morning when I got up of 40% cost overruns and some of the offshore wind projects. You got the likes of Siemens is just getting massive recalls, and this is early in the life of some of these turbines. These are supposed to have 25-year lives, and they're getting recalls in the first few years. So yeah, it's just there's going to have to be a re-evaluation of some of these projections. I can pull up a lot of the charts of just how much wind and solar was supposed to make up of the future energy mix, and how it's not even keeping up with energy growth, let alone the likes of Germany, who is probably the one that is throwing the most money at it, sort of somewhere in the marks of half a trillion, and they haven't even, I think, in terms of net energy, they only added like 1%. They didn't even that's just not going to work for developing countries. They need to, and it's why China's building 2 coal power plants a week. it's just the cold hard reality of all these countries that are adding a lot of climbing the S-curve and adding a lot of sort of people to the middle class. They need a lot more energy, and so it's just that realization. I think that's just a massive opportunity, and that's all I'm trying to take advantage of in the portfolio, whether it's coal, oil, uranium. Yeah, just trying to front run that demand.
So when you're looking at all this stuff, how far along do you think we are in this cycle? I mean, are we still beginning? Are we getting towards the middle? Do you think we're towards the end of this kind of energy boom, we'll call it?
Beginning. Yeah, no, it's just like none of this stuff gets fixed until there's a realization that there needs to be a lot of money spent to kind of fix the supply problem out a few years. It's I think people just fundamentally don't understand the difference between the early 2000s going into just using uranium, for example. There's this idea that we can just have another spike and we're fixed again. And if you go back to look at 2005, 6, leading up to that spike, if you'd look forward 5 years, the market was always in a surplus. Every one of those years going out, there wasn't a deficit sort of in the future. And so that massive spike was just driven by kind of a panic and over contracting by the utilities, obviously some of the flooding, but at no point was there ever really a dirty big structural deficit facing them. And you could say the same with the oil market as well. There's like parallels of that as well, with some of the spikes, kind of like embargoes and whatnot. Like, sure, it constrained it, but the oil was always there. It was just like a geopolitical problem that needed to be worked through. But now a spike's not going to fix anything. We've got serious deficits going out, wherever you want to pin the deficit for uranium. Sort of, yeah, I haven't even tried to work it out lately. But say, 17 million, whatever you want to call the deficit of a few years out. Oil, you're in the same. You're sort of getting a few years out. You're starting to run a few million deficit. And none of that gets fixed by just a one crazy spike to sort of whatever it is, 200 pounds uranium or $200 a barrel oil. Like that, we need sustained capex, which is going to make this particularly hard to trade in some circumstances, because you might get some crazy blow off spike, which makes for an attractive exit, but the problem hasn't been fixed. And so that's something I kind of think a lot about, how to try and handle that. But yeah, to answer your question, I think we're really early. I think the realization's only just starting to set in, and it's probably going to take another sort of cold northern hemisphere winter to sort of really ram home the fact that renewables are a pipe dream, and there needs to be sort of a focus on baseload and cheap energy. I think you're going to see political parties start to run on. They won't call it like coal or anything. They'll call it like pro business, pro growth. It'll be masked as bring back sort of cheap coal, cheap oil, cheap everything, to try and get the sort of economics running again. I think everyone overestimates how much people want ESG, when I've largely seen ESG, it was a nice to have when it got tacked on to, like, a lot of the ESG funds were simply tech and drag. You picked an ESG fund and all it was kicking out all the energy stocks. It was short energy and it was long tech, because tech by default is lower emissions, lower, scores well on all the ESG scores. So it was kind of like a long short trade. And now that trade's run its course, I don't think anyone's going to put up with poor performance for very long when they're just doing it for ESG, for feeling good on that. If they're getting constant underperformance, they'll start jumping ship. So yeah.
So just to kind of, I'll say, frame it, still a huge energy bull. We're super early in this mix. Renewables are most likely garbage to most extent. The old stuff's still going to work, fossil fuels, uranium, all those things. I get a lot of questions, people who aren't participating in this bull market yet. Obviously, we are both highly, we'll just say we're on the energy fossil fuel side, from a cash flow perspective, from a usable, net energy gain perspective, energy return on energy invested, all that stuff. Fossil fuels are the proven winners here. How does one build a portfolio right now, being in the location that we're at? Portfolio allocation. Should we be going after the small little companies? Should we be going after the mid caps? Should we be going after the big dogs that are like big diversified, oil producers or whatnot? How does one build a portfolio right now if you didn't have a position today? How would you go about doing it? What would your thought process be? How would you kind of weight some of these companies going forward if you didn't have a portfolio right now?
Yeah, so it's tough, because obviously when you enter the risk reward, I always mention with uranium, when I entered, I love the risk reward, and now it's kind of, I think the train's really left the station now. If I was given cash today, I wouldn't find it nearly as attractive. I would still find an allocation, but not nearly what I weighted it at the time. I think some of the most attractive is still things that people think aren't needed moving forward, and the classic case at the moment is coal, when it pretty tight correlation with the likes of natural gas and or TTF, LNG sort of in Europe, and so the fact that it's bombed out, that's a real opportunity to me. So if I was to re-weight a portfolio today, it would largely be probably a good chunk coal. It would be a good chunk of still oil exposure. The fact that I still think oil's cheap here for what's to come. That would be a range of sort of oil futures, offshore exposure. I don't generally go after the big companies. I really dislike a lot of the sort of politics. Like I think I sent out a week or two ago in my newsletter, there was this article on BHP, how they're trying to get like diversity across the entire company and even on the mine sites, and they're just like I'm all for sort of equal opportunity, but this equal outcome is just ridiculous. Like just trying to push women into like
everywhere.
every corner when they necessarily don't even want it. I think I heard I think it was Jordan Peterson. He was talking about it on one of his podcasts, and he was saying like even in Scandinavia, when they're trying to enforce it, like there's some jobs where people just like the genders just want to split. And he was using engineering and nursing. Women are more caring; they make better nurses, and so even when they were trying to enforce like an equal outcome, society didn't want it, and men enjoy being engineers more, and so it was. Even when you try and enforce it, sort of push back, and yet here we have BHP trying to, like, they're largely like kind of getting rid of, like promoting people that are underqualified and getting rid of people that should have had the job just to tick some box. And I just don't want any of that in the portfolio. They're also kind of, with a lot of the spin outs, like it's interesting opportunities at the moment. HP's spinning out some of its assets and trying to frame itself as a green company so that it can get possibly cheaper capital and get a higher multiple. But it's just whenever you make decisions that aren't based on sort of economics or profit, I think it's always going to come back and bite you in the ass. I think we're in the early stages of the whole whatever they call it. Like I've heard a million different conscious capitalism, like all the different versions of sort of ESG capitalism. We're in the early stages of that kind of really breaking down. So I try and stay away from all those larger companies. I think the sweet spots are sort of a lot of the sort of middle tier, if you will. Specialists. I stay away from exploration because I'm just not smart enough to see which are going to be the winners and which aren't, and it annoys me too much if I put capital into something and it just is a dud when what I thought would happen with the energy markets comes true. Like kind of, it's nothing more annoying than if you, I don't know, you had a little basket of explorers and they all go bang, and later oil goes to $200 a barrel and you wasted that capital. That always annoys me. So I kind of try and de-risk it as much as possible. I've always had sort of an approach where I have a hurdle and I don't try and get too greedy past the hurdle. Like an example would be oil futures. Like if I can negate a lot of the like of a long dated future on sort of future option on say WTI, you're removing the operational risk, you're removing the jurisdictional risk, and you can still get a hell of a payoff if we see it occurs. Why would I then take all those extra risks if I don't see a significantly higher payoff? And so that's how I frame a lot of my portfolio. Like I don't want to waste capital. It just annoys me seeing stuff. I'm happy to sort of ride volatility because I know that's sort of a necessity of high returns, but I get really annoyed when I kind of just do dumb stuff and kind of completely dust the capital. That irritates me. So yeah, I just fall in that middle spectrum, and then I try and de-risk it as much as possible. Yeah, from there.
Here's a statement. Tell me if you agree with it or not. And this is dealing with risk reward. If you've got a company that's a larger company, but it's got a bunch of upside, you prefer that company over a real small company that carries far greater risk that may or may not have greater upside. So you almost want to pile into those bigger ones at the right time than, say, a smaller company just because it stayed down. You don't necessarily want to migrate to that one. Is that a fair
Yeah,
statement?
exactly.
And you said, I'm not smart enough to buy the junior, junior exploration. Maybe you're smart enough to avoid the whole thing altogether. Because that's really
Yeah.
what one conclusion, at least that I come to. It's like, you know what? I'm not really going to allocate much money to these small juniors. The risk is too great and the rewards are just not worth it because your probability of success is so low in a lot of these explorations. You just get diluted to death. It's 1,000 cuts of death. Or you die by 1,000 cuts, I'll say, 1,000 down days of dilutions. So I think we have probably very similar approach for allocating capital and how I would do it. How do you determine like what percent to allocate to each sector? For instance, I could be a gigantic uranium bull. I look at the companies and you're like, where do you allocate the money in uranium? And then I go look over at oil and they're just oozing cash flow. They've got the infrastructure in place. They're pumping they're pumping cash flow at a very low, what I think is a very low barrels of oil price. How do you determine what sector gets what amount of money? Is it something like I just described there, or how do you determine what company gets what amount of money? A large company versus a small company? Is it based off of risk? What's it kind of based off of?
Yeah, so it's generally based off risk. I've always had a very, like, I start with a very structured framework of how I want to allocate positions. Like, my theoretical breakdown was always going to be ideally four different sort of themes. Each I was gonna, sort of allocate 25%, and then from there I wanted it to be at least sort of 5 positions and possibly smaller. So like very rough sort of framework to kind of approach. And that's just to manage risk. Like, I'm not one of these people that can ever, I can't sleep at night if I have a 20% position or something at cost. I've got way bigger than that because stuff's run. But yeah, I would never go in. I don't back myself enough to sort of to think that I can ever know a company well enough. Like, I've had too many surprises, and yeah, to delude myself with the idea that I can kind of really understand some of these companies. And so yeah, from there it breaks it down to, if I like a company, I've done a lot of research, then where I'm most comfortable is generally the 3 to 5% allocation. That's something that I've done a lot of work on. I'm really happy with it, and I usually start in the 2 to 3%, and then I'm looking for sort of some volatility event to increase the position size. And so that's how I usually arrive at the 5%. It's not all put on at once. It's really using the inherent volatility in a lot of these positions. It's just horrendous volatility. Like the one that I've often talked about was Paladin. Like, my first quarter to even a bit more of the position was at sort of would have been 12, 13 cents. And then the rest was sort of 4 cents, 4 or 5 cents. And so that often happens, is like, it's kind of as you build up the thesis and you kind of add in, and then you often when you have the sort of the real liquidity crunch, like that was March 2020, then if you've done the work, then you can really add heavily. And it's just always expecting volatility with a lot of these positions, because very, very rarely have I ever got on something and it's been quite a linear move up. That's happened so rarely to me. So I've kind of very occasionally you get the annoying thing that you get your first 1 or 2% and it just runs away on you. And then I have almost like a sort of a call option type sort of approach to a lot of positions, and this is from my mentor Brad. This is his kind of trading style more, is he just allocates the 1, maybe 2%, and these is just sort of the bottom crawlers breaking out. You're not doing the level of work that would arrive at 5%, but you're just seeing sort of margin of safety as the business turning around. What sort of assets? Like an example would be sort of a offshore service vehicle, a small one. I'd go through and try and work out what you get in the each vessel for. I'd look at the cash, how much runway do they have? They're not diluting you too heavily as sort of is EBITDA turning around, just all the what's management doing, just all the basics enough. And then I kind of view a lot of those as kind of call options without the time decay, or if there is time decay, it's just dilution. And so I can get some real strong asymmetry, and yet I'm not taking on, I just hate having time decay in my portfolio. About the only place I'm really accepting time decay is with some of the oil futures options, and those are quite long dated. Most of those are at least 2 years out. And so yeah, that's kind of how I approach risk. Like I've often said, my position size is my stop loss. I've never used a stop loss. I think stop losses are sort of make you, Brad always said it makes you short volatility, and you never want to be short volatility in your portfolio. It's got this whole philosophy that you need to just be able to, if things, the market's crashing, you should be able to just not look at your portfolio for a month or two. Or if you are going to log in to put a position on, then you shouldn't see the balance. You don't need that number in your head. He's big on protecting your whether it's confidence, whether it's just not letting your emotional sort of basket take control. Because anyone that thinks you'll always be fully rational in a sort of in a big bust up in the market it's not how we're set up as humans. Like when I was using that story before of Paladin, those positions got filled because I'd put those orders in a week earlier, and I was like, God, I'd be happy if these got filled at this level, and put in like a ladder of bigger and bigger positions till it used up most of my capital. When I actually saw them going off, I had to like hold myself back from going in the account and like absolutely like selling immediately, being like, no, this is just horrendous. Like, what's going on? This thing's going bankrupt. I'm just going to completely dust capital. This is feeling sick to the stomach. And yeah, I guess there's a real big lesson in that, is the less comfortable you feel when you put in a position, and with hindsight, the better the performer was. Yeah, I can still remember Peabody. Even if you watch the video, I still got up on YouTube when I did sort of an hour chat on it.
We lost your audio.
Okay.
Okay, you're back. You're back.
Yeah, sorry, this is the internet's unstable. Sorry. Yeah, and so yeah.
We lost it again.
Damn it. What was that?
You're back.
Sorry, the internet's coming up unstable.
Okay.
Cool. Can you hear me now?
Yeah, I can hear you.
Yep.
So uncomfortable making positions when there's a lot of fear in the market also makes you uncomfortable, just like it would be with me, as things dive bomb between stop loss, your buy orders. You said you laddered your buy orders. I do that too sometimes, where you put them in certain positions, and then you'll put every dollar increment or 50 cents or 10 cents, whatever the stock price is. I do that every once in a while as well. No stop losses. I don't use stop losses either. We take big asymmetric bets where we think we've got 5-10 baggers to the upside at least, very minimal downside, something that's been blown out. Very similar to me as well. So I think we're all very similar. When you look at things, I know like Paladin back then, they didn't have any cash flow. They didn't have any of that stuff. Do you overweight companies that have a lot of cash flow versus ones that are very speculative or ones that do not have cash flow? Or do you kind of avoid those companies that don't have cash flow?
I've got a place for them in the portfolio. So I have the coal side of the portfolio was making up for the cash flow there. And so that
Mhm.
was, yeah, very cash flow heavy. Whereas uranium, I always viewed it as, yeah, more of a call option on the sector getting sort of a squeeze in the future. And I really liked Paladin and a lot of the ones that already had the infrastructure in place. That was when we were also starting to see cost inflation really take off. And that's when I was really getting rid of a lot of the sort of the more speculative sort of developers or explorers. I've only got one or two sort of explorers that I, again, going back to viewing them like call options, kind of want the guys. Like I've always had a philosophy that I always go in after companies have gone bankrupt and try and get the ones that have got a whole lot of assets on the books that will take a lot of money in the future to sort of replicate, like the
Offshore,
yeah, offshore is
offshore
like
drillers. Yep.
yeah, you just like it's a moat. Like you've got you got these whole fleets of drill ships that are now being held on the books for bugger all, and they will be, if we're in an energy crunch, a sort of a commodity crunch, then they're going to cost a lot more to build in the future,
Oh yeah.
and the capacity to build them is not there. So you just got this, or you can use. I've often used. It's escaping me the name of the mine, but with Peabody, they had an acquisition. Was 2010, 11. They bought I say it's MacArthur, but I might be mixing it up. In Australia, like Met Coal bought it for sort of 5-ish billion and then wrote off roughly 5 billion in the bankruptcy. And so when it came out the back of that, you've got this asset now on the books, and you've written off the sort of the debt used to acquire it. So you've got this asset for nothing. And so, yeah, Paladin obviously went bankrupt and wrote off a lot of the senior debt holders got equitized, and you also have a nice sort of alignment of incentives when you've got these senior debt holders now being equity holders. They need to ensure that the company has adequate runway, and yeah, it's one of the few times that you're kind of alongside them in the sort of the capital structure a lot more.
Okay. And right now you live off your portfolio. You're a full-time investor.
Mhm.
How do you live off the portfolio? I mean, if we can ask or share, how do you generate income? Is it from dividends? Is it from like, I don't know, doing some sort of options like covered calls or something like that? How do you generate income from your portfolio, or do you have gains and you sell them off and you live off those gains? Like what's your strategies there for growing the portfolio, but also living off the portfolio? I think a lot of us are in accumulation phase. We're accumulating, but we're not living off of the portfolio yet. How are you managing that, or how are you doing it?
Yeah, well, I don't really live off the portfolio as much now. I do for any big expenses like
Mhm.
yeah, like buying, yeah, like housing and cars and all that. But yeah, for more recently, it's been yeah, had enough of following through the likes of, yeah, doing work with Crux now with my own
Okay.
Substack. But no, for the first since I quit my job when I was 30 through till probably COVID was when I even started online. So that was all done purely from my portfolio, and that was a um, mix of sort of covered call writing, and then I kept. So I had two separate portfolios. I had one on IB that was they were both IB. Um, One was income based and one was long term based, and so I just ran a number of strategies there that were all sort of income option based to provide me sort of a monthly income, and that was all revolved around covered calls, um, I had sort of a sort of income strategy that I set up in Europe that worked really well. That was on the Amsterdam exchange, and that was just doing covered calls, but using really sort of long dated futures there. So that worked really well till right through till 2019 when it just stopped working, which is another theme in all the trading. Whatever you get really good at invariably stops working on you. And so you have to kind of reinvent yourself over, which at the time that seemed like a massive issue for me. But then it turned out it was a huge blessing because I spent way more time researching some of the commodity companies and had this big pile of cash come March 2020. And yeah, if anyone wants to sort of learn to sort of live off the portfolio, the way I've kind of always explained it is at the moment, I think the opportunity set would be to identify companies that you want to hold long term. Ideally, that could even have great dividend yields, so that can build a portfolio, you can live off of that, and then you can write covered calls on top. So some examples of that might be the likes of some of the coal companies are just fantastic for this. I've talked about sort of Peabody. I've easily would have made my original capital in Peabody back in writing covered calls over time. A very liquid option market. I've done it with Whitehaven, done it where over time with some of the offshore names, they've got quite liquid option markets. And so just getting very comfortable with options. Back when I first left, it was like a monthly thing. I was just hunting out every opportunity and almost forcing it at times. Now I only do it when I really see a juicy setup. So I might only put on a covered call every quarter or maybe even every 6 months when I see it really set up and it looks great. I'm not as income orientated as I used to be.
So writing a covered call, you're basically collecting the premium, and hopefully it's not it's out of the money when it goes and expires, right?
Yeah, so the CBOE, the Chicago Board of Options Exchange, they did a great study going back to 1986, and they compared all the different strategies you could do with the, I think it was with the S&P, and it was like writing puts, different levels out, just holding straight S&P, and yeah, a whole lot of different, like writing butterflies, a whole lot of different option strategies. And the one that outperformed everything over this long time frame was just writing covered calls that were about 20% out the money. And that always stuck with me, because if you can kind of continue to collect the capital gains on a sector, and this is what I did, this is how I built actually a lot of my original wealth, was just managing to hold the underlying positions as the capital gains grows and still kind of skimming profit off the top and enough to live on. And there's something, I don't know why it works so well, but that 20% out of the money works a treat. You generally can, it's the best of both worlds. You get exercise very rarely, and you still kind of get enough premium to make it worthwhile. And especially if you do similar to what I did, which was reinvest a lot of the premium in the underlying, and so you get this kind of snowball going where you're living cheap. Like, that's why I found myself in Bali for a while. Like, the cost of living here was really low. I've got a good friend now who's doing it in Buenos Aires, and he's just living a great life for sort of 1,500 US a month, and sort of building the portfolio that way. And I've always thought that was, it's kind of the smart way to do it, while having enough exposure to some of the more sort of asymmetric stuff like uranium, like a lot of the offshore stuff. I think will pay off big if you've got enough patience. And so, yeah, that would be my recommendation, would be for everyone just to get really comfortable with covered calls, because they're very simple. Like, I kind of joke, it's one of those things you shouldn't over intellectualize. You should just learn the basics of it for a day or two, and then go in. There's some positions you can do a covered call for like a few $100, and then just write $20 of premium, and then just do it month in, month out until you understand every sort of what been assigned? What if it expires worthless? What if it, like, you just know every iteration. And then the great thing with it is you just, there's no difference to writing one option or writing sort of 100. It's just zeros as long as you understand the whole process. And so I think it's super powerful, and it's one of the one of the things I always harp on about, because it's once you understand it, you can start to see a lot of opportunity everywhere with doing, like, creating income from options.
And what did you find is like the sweet spot for the duration of the call? I mean, is it like 3 months, 4 months, 5 months? Do you want to do shorter ones, like a month or two? What were you using for the duration of that covered call, the call option?
30 days, yeah. So it's like somewhere between the sort of 3 weeks and 30 days is a sweet spot.
Okay.
You can pump up the income a lot if you go to weeklies, but then that's just a huge amount of management. So that's if you're going really full time. I did that for a year, and it was just, I did make more returns, but just the amount of management of it, I could do it as well because I was living in Europe. I lived in Berlin for a year and a bit, and so that was when I was trading those European indices. So I was kind of at my laptop anyway, and just sort of micromanaging a lot of the positions. But yeah, looking back on it, for the amount extra I earned with how much extra work, it wasn't a good trade-off. So that 30 days is definitely the sweet spot. And then the returns really drop off after that, and also sort of the risks go higher. So no, from all my experience, that's what's always worked the best.
So looking backwards, I mean, you transitioned from working from a 9 to 5 job. You transitioned out of that job into using your portfolio, obviously maybe generating some income from YouTube or online or whatever you're doing. How does one do it, and how do you expedite that process from 9 to 5, get me the heck out of the rat race, to where you're kind of at right now today? How would you go about that? How would you tell yourself when you're sitting at your 9 to 5 job, staring at the screen, saying, "What the heck am I doing here?" What would you have for potential, opinions around that for people who are watching that are doing a 9 to 5 job, that want to get the heck out of there?
Yeah, it's tough, because I don't think I was possibly the best example of how I did it, because I got a high paying job and just didn't like the job. So that's obviously a luxury in itself, to have that sort of ability to stack away a lot of capital quickly. And a big part of the reason was I just didn't enjoy the work, and also the tax regime in Australia was just oppressive. Like, I remember my last bonus, just looking, and it was 50% tax, and then 10% had to go to super, like your pension, and so you're getting like 40 cents on the dollar. I was like, this is just, why am I wasting my time with like more work? And so that kind of forced me out. But if I was to do it from a I don't know, if I was to do it all again, I guess I'd still have to do the work to save. Like, I think it was Charlie Munger or someone said, like, the first 100 grand's a bitch. It's so difficult, takes a lot of grinding. But yeah, you have to do it. You have to, no one can start trading from sort of nothing. So you have to find what you're good at that pays you the best, and grind that out with that. But then I think everyone's overly glorified this whole FIRE process. If you have to wait till you had $1 million and then you can survive off 4%. Like, when I quit, I only had it was only a bit over 200 grand, and so I didn't have enough money to be set for life, like a lot of people sort of impose. Like, I had to make my money really work for me. And that's where this sort of educating yourself of options is hugely beneficial. Like, I dragged somewhere in the range of 3,000-4,000 a month out of that sort of portfolio, and that portfolio was split between sort of 100 grand in income and 100 grand in and long-term stuff. And so I was pulling, 3-4 grand. The big caveat with that was that would be like probably half the year, and then there'd be periods where I just wouldn't be able to make anything in the market. So it was never consistent. That's the first thing you give up, is your consistency and your security once you give up your paycheck. When you sorry, that's bouncing back a bit, but no. Whenever you need income, invariably the market won't give it to you. If you've got like a medical bill or something, then it'll be the month that you can't make a cent out of the market. But I think, looking back, I wish as soon as I'd started working, I'd started learning options quicker, because when I decided I really didn't like my job and I wanted to leave, that was already a number of years in, and I got up to speed and kind of almost matched my income after sort of a year and a half, 2 years of trading options. And I think if I'd done that far earlier, I would have been able to get out far earlier. And so, yeah, I just think it's such a powerful skill. And also now, just the opportunity set's great as well. So if you can, at the same time that you're learning that skill, you can latch on to some of these more asymmetric bets, then you could create a lot of the capital a lot quicker than sort of grinding it out with income. So sort of, the idea of whether it's catching some of these likes of a squeeze in uranium, or just a nice steady sort of bull market in coal, or bull market in offshore, a lot of that, if you can latch onto something that multi-bags, then that's going to make your capital base to earn option premium off a lot bigger. And at a point, you can have a big enough portfolio that you just purely live off the likes of dividends, which is what I'm kind of aiming for in my personal life. Is on the long enough time frame, I'd like to sort of have sort of a coal portfolio, or something that's sort of knocking out a double-digit dividend. And yeah, if I don't do anything, I'm still collecting more than enough to live a great lifestyle. And so, yeah, that would be looking back. I was lucky enough to meet a great mentor, but it's a question I get most often, is how to find a mentor. And I honestly don't know how to answer it, because the more I've found, the people that are willing to mentor sort of one-on-one, they're usually quite sort of markety and salesy, and they're not, if they're doing really well, why would they take a one-on-one mentor? Like, it would just be a lot of work for them. And they're doing well in their own life, so they don't really have time for it. So it's a hard thing to find. I just got super lucky. And yeah, I guess that would be some reflections on my journey.
Did you, when you were going through that and you left your job or whatever, did you find yourself more, I can't find the word, more desperate, more vulnerable, more edgy in the markets or anything like that when you had left?
Yeah, no, definitely. Like, you never make a good trade when you come at it from a place of desperation. It's like that same sort of parallel to like dating. Like, if you go into a sort of a club or something and you're desperate to meet someone, then like everyone runs from you. And it's the same in the market. Like, if you're desperate to make money, then it always evades you. Like, most of my money, like has been almost like just being lazy and letting things run and get away from me. Like, I had one trade with Liontown more recently where it was in a portfolio. I kind of looked at it occasionally. I was like, oh, that's doing well. I'll just let it run. And at some point it had got to $1,400. It ended up, when I sold it after they got, they had I forget what bid they had, whether to be acquired or anyway, it had a massive jump and got to 104,000, and that was just so nearly, not quite 100 bagger, but getting there. And that was just through being kind of lazy, not really doing anything with it, just looking at it occasionally, thinking, oh, that's interesting, it's doing well. But if I'd been in those early years, there's no way I would have ever let anything like that happen. I would have been all over it. I would have sold it for something else. I would have been super active. So there is a lot to be said for having a more sort of lazy approach with the long-term stuff. You can be, that's why I always like that I sort of split my portfolios, because one portfolio requires you to be active and constantly involved, and the other requires you to keep your hands off it. Ideally, if you're going in there, it should be to put in sort of limit all orders at good prices. You shouldn't be going in there to panic sell something. That's just, yeah, it should never be sort of acting from a place of emotion, because it just generally doesn't work. Yeah.
Here's another really, well, I think it's a difficult question, but maybe it'll be easy for you. How do you know when an investment or a company or whatever you purchased, how do you know when something's successful or when to pull the plug on it? A lot of these companies that we go in, we don't have stop losses, because this is something I always look at too. It's volatile as all get out. You're most likely going to be down in the position at some point after you buy it. How do you know when to pull the plug, and how do you know that you're onto something that might be good?
Yeah, well, that's like, it's always a really tough question. It's like, so I've always got this thing of like having conviction riding through volatility, but then when do you know like to pull the plug on a loser? And that, I think, to start with, you got to define what is a loser. And a loser is not just a stock that's gone down because of volatility. I've had lots of them, and I've wrote some stuff down pretty, like the Paladin example, wrote it down from when I first started looking at it, it was 15 cents, wrote it all the way down to 3 cents, and then all the way back up to where it is now. And so if you just were to judge that by volatility, then that would have been a massive loser. But the way I kind of view a loser is it's often if there's kind of the reasons for you getting in have changed, like whether they're not executing, management keeps pivoting, you've seen stuff you don't like out of management, or one of my favorite tricks is whenever I really sort of bother with management interviews, but if I am going to watch one, I watch them back to back from like a year apart, and you can tell a lot by like body language what their aims are, if they're pivoted to something else, if they're like avoiding a question that they were all over in the previous interview. I've always got a lot out of that. So I do exit positions if I just feel like not liking the sort of what I'm seeing from management, or what I'm seeing from them, sort of if they're supposed to be executing on something. And I've also come around to just getting rid of positions just because of sheer underperformance. Like when the whole market reacts to good news, and it might be say like a basket of the offshore names, if they all good news comes out for the whole sector and everything jumps 5%, and the one that is still holding it does nothing, or might do like 1%. If that happens enough, the market's telling you something. You don't need to, I think Brad has said, you don't need to over intellectualize every reason for exiting. Like if it's just lagging and not reacting to news for long enough, that's a reason in itself. So I've kind of got better at that as well. If something's just sort of dragging its feet constantly and I can't understand why, I'll just move on, reallocate it to something that's sort of reacting better to positive news. And often when they are not reacting to positive news, it comes out later that there was some sort of underlying reason for it. You just didn't pick up on it at the time. So yeah, that's kind of overview. But yeah, it's super tough, and it's all very obvious in hindsight what should have been done.
And another question here. I mean, obviously that's telling if something's successful or not. What condition in the market, when you see it and it happens to a certain company, if you were to have like this perfect alignment occur, what does that perfect alignment occur where you would say, I'm going big here? Like I'm gonna stack some money in this thing and go towards your upper level position. Is it fear in the market? Is it a specific company with some sort of an event that happened around it? and there's fear in the market. Like these things kind of all stack up, and you're like, oh my goodness, this just looks ridiculous. I'm going in big. What does that look like? And some people, they ask me that, and I'm just like, well, everything's got to go in this alignment, and then once it hits, it's like, boom, let's pump it. What does that look like to you?
Oh, the one that's always obvious is if there's someone doing something for non-economic reasons. So whether that's kind of just an absolute um, sort of a liquidity crunch, like the sort of March 2020 when just everyone was just selling. Like there's nothing that's holding up. Everything's just getting destroyed. And so that's when, if you've done your work on the investment, you can go in and really back up the truck, like really push the position sizing. You've got the ones that where it's someone making it for a non-economic decision, like spinning something off, like I don't know what's coming to. I've got on YouTube. I still look it up when Diamond relisted. So just worked out what the valuation should be based on what some of the new drill ships, and then it just got absolutely dumped on the open, and so picked up a whole lot. Then I was just like, this is trading for whatever it was, 2-3 drill ships. It's got a handful and some old semi subs. So I think this is just way too cheap. And so backed it up. Then you had the likes of Peabody when it was. I guess that wasn't really one point in time, or it was actually when they threatened the second bankruptcy and everyone panicked. Then just sometimes when you just see you've done enough work that you understand that that price makes no sense at all, and what's been sort of perceived as risk is just people panicking that haven't done the work and don't have any conviction, and that's when you've got to try and step up, which is hard. But yeah, if you're happy with the process, and that's why I stick with stuff that I can, not that smart, like with the diamond stuff. That was pretty easy. They wiped out the debt. I can kind of with ESGen had worked out what a rig was going for on the market at that particular time. Like they've got that kind of bid offer for some of the drill ships and semi subs. So just table napkin what it should roughly be worth, and then lo and behold, fast forward whatever it is, a year and a bit now, and it's up to 200%, 300%, 200%. So yeah, that's what I kind of look for, is those sort of setups where it's and with coal, you just got the, like, how cheap could something get on like just piling cash. Like you can't have a value trap when someone's just spitting cash and stacking and doing buybacks and handing dividends. Like everyone's always like so frightened of this value trap, but when you look at across the coal sector, the only thing that frightens me now is governments bloody taking all the profit off you. that's the thing to dodge. It's not the idea of a value trap in a lot of these things that are just trading at 1 to 2 times sort of free cash flow.
I was gonna tell you what's a scenario or a spot that you don't want to be in. Like, what is something you want to completely avoid, where you can just get your head cut off? Would you say something like in Nvidia right now, or something like that? Would that be something where you're just like, what are you doing, guys? Like, get out. What kind of scenarios do you see there where you can just get absolutely slaughtered?
There's some interesting ones where you work out how much of some of these floats has been cornered by passive. And so this is like, I think it was Mike Green that first talked about it, and it was when you got some of these big stocks that have actually got quite tight floats. When you look at all the sort of insiders, they haven't got that great a liquidity, and so there's just this constant bid from passive that is just jamming up the stock price. And this is, we all know the top 7. Like you can, I saw a chart this morning that was just, it's at like an all-time high as a percentage of the S&P. I think can't remember what exactly. It was nearly a quarter of the S&P. It's just in 7 stocks, and it's just gone vertical the last few months. And that should worry the hell out of anyone when you consider that all those flows are coming from, a lot of those flows are coming from passive, and passive is now far larger than sort of active. And if something else ever starts to sort of outperform, aka like energy or something, then to rebalance, who are those sort of nosebleed assets going to get sold to? Like, it's not going to be the active segment that's been crushed. They're not going to be sitting there waiting to take sort of all the stuff off at crazy high valuations. So there's going to be this like air pocket if there's ever this rebalance. And it was really interesting hearing Mike Green talk about it, because it kind of cuts both ways if you don't have great liquidity. And this goes back to like, it's not like the market makers that there used to be. A lot of this is the high frequency guys, and if things get too crazy, they just step back and kind of switch off their machines. They're like, oh no, we don't want to partake in this. There doesn't have to be an orderly market. And so he was saying, this was a few years ago, but he was saying with Apple, for at the time it was I can't remember what valuation it was, maybe just crossed $1 trillion or something. And he was saying it was only like 30-40 million of liquidity for something that was trading that high. And so that's fine, as I say, when it's going up, keep jamming up the float, keep increasing the price. But that cuts both ways. If try and sell out of that, and it goes kind of, there's big air pockets and it goes no bid. So that's the stuff that's seriously dangerous, and I wouldn't want it anywhere near my portfolio. I think the Aussie banks are bug looking for a windshield. And as for stuff I just don't want either, it's a lot of the stuff that there's a lot of like sort of technical, like a lot of the miners and stuff, it's outside my circle of competence. I think you can do really well in investing if you just say too hard. Like if I have to understand some flow rates of barrels of like, or get into the what sort of like dig into the geology of a mine, like I'm out at that point. Like you could be telling me absolute gibberish and I'd be nodding my head to get fooled so many different ways. Like I always loved on Crux reading like sort of some of the ways that people like just trick all the tricks and all the bullshit that goes on within the mining industry of there was just a long list, and I would have got caught by every one of them. So the way I avoid that is just by trying to dodge that altogether, knowing that it's outside my circle of competence.
Do you think the tech sector's a spot where things could just roll over? Because there's a lot of money over there, and obviously money could rotate. We're hoping that money's going to rotate over into the sectors that we're in, commodities, energy, all that stuff. Do you think that's one sector that's just it's ready to roll over or just go sideways for a long time? The tech sector.
Yeah, well, it's I've got a chart somewhere that shows like the amount of money managers that have like, I think it was Microsoft, or it was like 80% of like money managers now own Microsoft, and it's like at what point is there no additional marginal buyer? And especially if what I was saying with passive rolls over, like there is a point at which something is so well known and becomes so saturated. Like there was I mentioned this to one of the members, and he dug up a meme and sent it to me, and it was like a guy in one of those bomb suits, and it's going to your portfolio manager suggesting that you like reduce the Microsoft position a bit. It was just, everyone's so overweight this because it's worked so well, and it's I think there's some interesting sort of parallels with, I think I saw someone drawing the parallel with either with Cisco with NVIDIA, but there's a point at which you can the company can keep performing. Like the Cisco examples, the company kept performing, lived up to a whole lot of its claims, like it would grow revenue out for the next decade, would become the backbone of the internet. It would, and it did all of it. Like you can look back and it steadily grew revenues, was a great company, and yet it lost 85% from that sort of 2000 high. And that was just because it got crushed on the multiples. And I see that happening all over again. I see nothing but risk in those big 7 names. Yeah, if I had more balls, I think I'd probably look for sort of a short to try to capture what I just outlined with them, but shorting's hard. I always lose money and regret doing it, so I just decide not to do it, and then I forget what I've told myself and try it again with some options, and then remember why I don't do it.
You have anything else that you'd like to share? That's all the questions I've got. Is there anything else you want to talk about?
Not really. It's just interesting seeing. It's sort of been a slow. Maybe it's just because I'm paying so much attention to it. It just seems to be a lot more people sort of clicking on to what action needs to happen, like with, be it nuclear, be it with sort of a lot of the renewables not living up. In Australia, there seems to be more pushback on it. It's just interesting. I always sort of wondered how far this kind of the green sort of agenda would get when none of this stuff was really economic, and how much would try and be sort of enforced by more pushing with the likes of like the Inflation Reduction Act or Energy World in Germany. Like how far would they manage to push it when it wasn't working? But it seems it is starting to roll over, and maybe I'm just being naive, but it's hopefully like the coming winter, if the Europeans get a cold winter, we will see a turning point and a realization that sort of energy policy needs to be more pragmatic moving forward. But yeah, I guess in a few months we'll kind of start to know. But I think you missed.
If you didn't call winter, natural gas prices they're going way up. Same with coal.
They are. Yeah, it's a tight
okay.
correlation.
Well, that's go for it.
That's what I was saying. I always just viewed coal as sort of LNG without the infrastructure. So I always viewed gas as kind of hard to play in and gets a higher multiple. So that's why I've always kind of gone after coal. I think just a smoother sort of lower risk ride on the sort of gas thesis.
Yeah, gas is very volatile, which is why I love it and hate it. But that's all I've got. Thanks for coming on. Really appreciate it. If someone wants to reach out to you, how do they get a hold of you?
Let's jump on Substack, which is TraderFerg at Substack, is where I'm spending most of my time now. Spending less and less time on Twitter. It's interesting where it's going now. That's really the two places I hang out. Thanks for having me on, Andy.
Appreciate it. All right, guys, that's all we got. We'll catch you next time.